Welcome back. I think it's Wednesday. All the days are a blur. Markets being crazy. Let me just type in a message to followers here. So give me 1 second. We are here. Okay. Final hour live now, 3 p.m. So we're just getting started late. I just got off a webinar. Sorry for the delay, but coming in hot. All right. So what do we have going on today? Well, market started off real good. We gapped up about 2+% from the close. We were up about 2.11% to open the day, and you can see that it is now below where the market opened. So we're chewing into that gap a little bit. We still have, and this is interesting, we still have a gap up here that has not been filled. Okay, so that gap is still not filled at all. It was close on that April 9th high. It was close on that. So that would be Wednesday, Thursday, Friday, Monday, and Tuesday, and even today. But I think it's pretty obvious that we're seeing a lot of resistance, right? There's a lot of resistance right now that the market is still reluctant to cross above. We do have a death cross in the market. That's the 50 and the 200 crossing over. Let me change the color here, and let's go a little bit thicker. So this area, to me, is major resistance. And until the bulls can cross that, I don't think I'm really convinced that this market goes anywhere outside of maybe a range trade where we have this resistance that I noted in black and possibly this intermediate low that we bounced off on Monday, and of course the lows from April 7th. I still stand by what I talked about the last couple of weeks. I sent out some trading view videos. I've talked about it in the final hour sessions, and that is there's a lot of noise in this market over a 13.3% swing from this low to this high right here. Okay, this low to this high is 13.3%. So inside of this, where we have a 1% gap open, a 1% gap open, a 2% gap open, none of it matters. It's just noise. Because, I mean, I'll keep this really clean and simple. I don't think the bulls have any chance of going higher unless we see some really easy trend lines broken. And this might be so basic and so simple, but it's going to require some patience because the market is desperate for some good news, right? And all we have is we have some jawboning. You know, Trump is like, tariffs aren't going to be 145%. And Bessent's like, we're looking at de-escalating. It could, whatever, dude. All of it's noise, all of it's talk, none of it's actually changing anything. The only thing we have going on right now is there's a 90-day pause in this tariff window. Nothing's really resolved. China is playing hard. So are we. We disrupted the entire global economy by throwing this trade war together. And, you know, part of it feels like, yes, I understand the reasons for it, but man, it was so poorly executed and the whole world seemed like it's a systemic risk. And, you know, this right here is the easiest trend line to watch. Until we break above this trend line, I'm not super bullish on this market, which is why today's picture is fade the rally. You know, and I'm not super bearish. To be fair, I'm not super bearish, okay? But we're probably going to see a lot of resistance that will hold before this market is in control to let the bulls really rip. And so to me, where do the bulls take control? The bulls will take control up here. If the bulls can break this trend line and hold above that trend line, then yes, we can work our way back into these previous highs. We can work our way back into the 200 moving average. This might even form a bullish pattern, right? I mean, there's going to be a lot of trickery going on here. I could see this market still chopping around, you know, maybe waiting on the trend line break and then maybe building something back later. Maybe this July 9th is the buy the rumor, sell the news when the deadline's over and the market's already priced in the worst case scenario, but things get better. I don't know. That's months away, right? But right now, all this is noise. And until we are above this high or above this trend line, even if the bulls run this thing up to, let's say, 56 or 5,700, okay, even if the bulls run it up to 56 or 5,700, if we're lucky, there's a bottoming pattern that we can finally see developing, right? If we're lucky. The reason I say this is a very contentious spot is because if we come up to this level, that's be like, oh, that's a neckline. Well, does anyone know how to trade necklines? Does anyone know how to trade head and shoulders? Because if you start to buy the dip here, This could also be a failed head and shoulders, and this could be retreating all the way back down the lows, right? And this would destroy traders' hopes and dreams if they're like, oh, this is such a good bullish pattern. There's my bottom. Well, what if it was a V bottom? Or what if it was a double bottom, right? What if it was a lower low and then another pattern here and then a bigger drawn out bullish pattern? Like all these things can evolve. So there's no guarantee on where this market is going to take tops and bottoms. There's levels that I'm watching. I think levels are going to be fairly clean and responsive. The technicals have been very, very good over the last couple of months because even with this decline falling right through the 200 moving average was pretty premeditated. I was ready for that correction. The decline and pullback and then flush down to the previous all-time high was resistance becoming support. It was a great technical response to that level. As bad as things were for that 3 to 4 day dump, the market responded beautifully off that past high. So here we are now with a bunch of noise, right? So point is, until the bulls can break that trend line, until the bulls can possibly give us something exciting above the 5,700 handle, I'm not bullish. Okay. Does that mean that I'm just aggressively selling? No. I have hedges from here trying to get back down to the lows. I have hedges in here trying to get back down to the lows. If the market goes up here, I will probably wait to the highs before I put on fresh hedges. I might not put on any additional hedges in the middle because if this is a spot where the market comes in the middle and actually consolidates and it goes higher, well, it's just going to be a waste of money on hedges. But if we come back to all-time highs, I'm definitely considering maybe another high. This might be just an exaggerated move like we had in 2015-16 where we had a 20% range, and this market might do something like this. Down here, come back up, down here, until it figures out that it's going to take years to make all-time highs again. Or maybe it gets worse. 2007, 2008 did this. Fell, rallied, fell. Way worse in 2008. 2009's bottom was September. You had a long, stressful, annoying bear market. So this is not done. Nothing's resolved. Everything we're reading right now that's getting the market excited is noise. There's nothing actually happening. It sounds like we're talking a good game. It sounds like we're talking through negotiations and things should be improving, but they're not. Okay. OT, didn't I post that yesterday in the chat? Thought I did. Yeah, here's my Telegram. I posted the Discord link. Here's Telegram. So give me a sec. Here's my Telegram channel. Chris Pulver. Telegram. Okay, and by the way, just let me make a quick disclaimer on Telegram. If you think you're joining my Chris Pulver Telegram channel, this is the one that is posted. If it's something else, it's not me. If it's something about, hey, crypto this, and let me get all your personal information and scam, it's obviously not me. I have one Telegram channel. I have one Discord channel. I have one YouTube channel. Okay? So that is where you can find me. Here is, I think I've got channels. Yeah, right here. I've got a screenshot right here. These are the only places that I am. So these are my accounts. I'm live on youtube.com/Chris Pulver. I'm live on youtube.com/Financial Wars. My Discord is Chris Pulver Trade. Send out 30-minute invites to that only during live sessions. My Twitter handle is Real Chris Pulver. My Instagram handle is Real Chris Pulver. TikTok, I think, is Real Chris Pulver, but I barely use that. Facebook is The Real Chris Pulver. Telegram, Chris Pulver. That's it. Not WhatsApp. Not freaking some other smoke and mirrors website. Not some shady. It's like, come on, man. Like, there's too many scams out there. The fact that I'm in the public like this, I deal with it all the time. It's unfortunate. I hate it, but it's reality. So if you want to know where to find me, it's in Discord. It's on my YouTube channel. It's during these live sessions. Okay. All right. So technicals for the remainder of the day. Nice little swing P&L wise, starting to fight the good fight back. P&L for the year is fine. My high water mark is 205. So that's kind of my goal, is to get back to 205 and do that well before we hit all-time highs. I did take some profits today. I closed out some naked puts on Qs and SPY. Closed out a nice 111 for my Project Options Edge on SPY. I still have some trades running on Waterfall. I'm going to, after this session here wraps in the next 25 minutes, I'm going to do a video from Waterfall Income Traders because we have some good profits running right now. This trade is up about 55% of the credit. SPX, this trade is down slightly, but we're actually above our line in the sand. This is a May expiration, so I'm going to wait a little bit longer on this one. And then let's see here, that one's in profit. Okay, that's a wash for the day. So 2 daily profit play winners. I'm gonna wash a butterfly with a broken wing for a net profit there as well. SPY in profit by 36%, in profit by 56%, in profit by 50%. I'm going to let these run a little bit longer. These all have lines in the sand that are below the April 7th lows. I'm looking for a bigger chunk of wins. I could get $16, roughly about $1.60, about $1.60 in income, potentially have a profit trap that could be worth $5 to $1,000 to $1,500 in a profit trap. So, I mean, most likely I'll make 160 some dollars, but potential profit trap of offering some bonus credit. Maybe I can grab an extra few $100 on top of that. And these aren't, these expirations are out 30 to 37 days. XSP, same thing. This one's 520. We're trading at 535. I'll keep a close eye on this one as well for May 16th. Okay. I just think the market's going to be relatively noisy for the next 30 to 60 days. Right now, it's all focused on earnings. Tesla had terrible earnings, but we're still hanging in there because Tesla was so beat up. It's like all the bad stuff was priced in. Everyone was pissed about Elon Musk and Doge, and they're hating on Teslas and vandalizing cars. They're missing deliveries. Their numbers are terrible. But the reason Tesla is showing resiliency is because all the bad was beat in, and people are still excited about robo-taxis and excited about energy and excited about AI and excited about humanoids and excited about the future, where it's like, yeah, this is a future-based company. It's more than an auto company. It is probably a major, major tech disruptor. I hope that's not completely out of the cards now because, Doge and Musk are just, I mean, he's supposed to be leaving Doge in the next couple months anyway. We'll see. We'll see if the focus shifts back to Tesla. I own some shares right now. This week, I'm going to keep an eye on this one. By Friday, if we're above 257.50, I get Tesla called away for about $1,000 an account. I've got 500 shares right now. If it doesn't get called away, I am selling premium and selling premium and selling premium, and I'm going to lower my cost basis to try to make. I made $7,000 on Tesla a couple weeks ago. I'm going to try to flip it again for, this week could be worth $5K. If I don't flip it right away, I'm going to try to flip it for maybe $7, $8, $9, $10,000. And continue to kind of boost the bottom line and just keep grinding. Okay, all right. Let's talk top bottom. So 337. Verizon's back up to 52 or 42.56. Netflix is still looking okay. Got a couple trades out that I'm watching. We're at 1043. We need price to get to, I needed it to get above this line here around 1045. It's there. We hit highs. I'm going to see if we can test these highs a couple more times. I hope we can. If we can push a little bit higher in Netflix, that'll be good. I've got I think it's break even right now. It might be a small profit on it. Let me check. I haven't closed it out yet. Netflix is up. That's freaking down $20. That's annoying. I'm going to watch. I have the potential to make about $1.80 on the trade, but I need to see price stay above 1045. We've already pushed up. Netflix had good earnings. I'm hoping that any type of bullish sentiment that goes into the next couple of weeks can also help drift this higher, and we'll snag a couple dollars there. I've got a credit set to, I'm just going to go ahead and change this to $4.20. I'll try to take a dollar profit out of it. So that one's still running. VZ is still running as well. Okay, close out Tesla for a winner today. Still have the stock ownership running with covered calls and a modified collar. Mags, a nice gap. Nice gap to the upside. You can see it's fading. I think this is one that I'm really interested in watching. We have more Mag 7 earnings next week. So we have Google on Thursday, which will be another Mag 7 earnings report. We have Amazon, Apple, Meta, and Microsoft all next week. I think it's on Wednesday and Thursday for earnings. So I don't know if they're going to be fantastic earnings. They may be, maybe not. ENPH, Adrian, ENPH. I pulled that out of my options earnings scan. I looked at a trade on ENPH. I didn't take it. It didn't price out the way I wanted, but I know they had earnings and they're going lower. So we had a gap from 53 down to 45. I don't know if you're in it. I don't know what your plan is, but looks like a falling knife to me. So I don't really know what to say on this one outside of there's room to go down. Maybe it's oversold a little bit, but clearly this is at a bad run of earnings and this market's just been so crappy. Why is this stock down, 86%? I don't know, but to me, I would say this is a dead capital type trade. ENPH to me is not investable because why on earth, when there's other stocks out there that are up or fine or resilient or showing some some gains maybe. Why is the stock down 87%? So it baffles. And I get it. There's a whole mantra of like value investing and things that are over like fundamentally weak, and you can buy them when they're nobody want right. But to me, it's like, how long does it take for ENPH to turn positive? If I look at it fundamentally, let's find out, because I feel like there's going to be a lot of potential risks on this one. So profit margins lower, insider selling, trades below estimated value, only 2.6% below. There's not a lot of upside here based on a fundamental discounted cash flow. Earnings are forecasted to grow. Okay, cool. But price to earnings is probably dirt cheap. Nope, it's price to earnings 68, and this stock is down 86%. That's crazy. Fair value is, I mean, it's now $8 or $9 below fair value. The problem here is I look at this chart, I'm like, where does it stop? I mean, I don't want to trade this. I mean, maybe at $10 I'll buy ENPH. That's a low. It's like throw $1,000 at it, buy 100 shares, and let the thing go back to $70. Give it a couple years. I mean, the last time the stock had a great run was 2019, crashed during COVID, ended up peaking here in 2022. That was with the tech market. So actually, how the hell did this thing go up when 2022 was a bear market? Now that I think about that. Anyway, look, I see a lot of stocks like this where it looks low enough that it's like, oh, it's enticing to buy. But why? Why would I buy this? If this came down to $11, I would probably throw $1,000 at it, because I could buy 100 shares, control options, maybe take a trade at it, right? Maybe. So that's about the only level I see that I'd be like, oh, sure, maybe I'll throw 100 shares in. But I also expect that to do nothing. Okay. So I got no trade on it. Mags, like I said, next week with earnings. Apple, let's go to the daily time frame. Apple is, gapping up today. That's fine. I think we put in a pretty strong bottom. I took a lot of ratio spreads out of Apple. I have some covered calls as well. I'm going to still generate Apple income. So we've got a ratio spread that's out to January. Let me put this, I'll just review all of them. So Apple, I have some ownership. I got 400 shares of Apple. I've got some ratio spreads there. That is a ratio spread. Let me throw that one in here. So credit spread, naked put, which is up about 37%. I'm going to let that go further. That's a 160 put. Ratio spread here, up some profit. I want to be up more. It's up 48%. If this ratio spread starts to be up like 75 or 80%, I'm probably just going to take the profit. Ratio spread here, same thing. Bull put spread, still going to wait a little bit longer. It's up about 38%. If I get up to like 75, 80%, I'll start taking profit for capital efficiency. Same thing here. I mean, these are all the same. What else? Naked put, still going to sit on a little bit longer. Covered call. This one, so I'm up, $6,300 on a covered call. I've rolled this a couple of times. This is out to July, a 175. More than likely, as I get into like the final maybe 45 days or 30 days of this expiration, I'm probably going to just roll this for another 30 to 60 days. Even if I keep the strike at 175, I'll just roll it again. I don't think Apple's going to be a stock that just dumps, way, way, way below 175. So I will hang in there and I'll keep rolling calls and I'll try to roll it. I mean, the nice thing is if we stay here around, let's say lows at 170 and we kind of range back to 170, 190, I can just keep rolling it out 30 days, 45 days at a time, and maybe pull in like an extra dollar or two. It's on 400 shares. So if every time I roll it for 30 to 45 days, I make an extra $200 to $500, like I'll do it. I'll do it until the end of the year, make an extra couple $1,000. I think there's some resiliency in Apple. If we obviously get out of this trade war funk and the market can go higher, then I'm sure Apple's going to be okay to possibly get back towards recent highs. Is this the bottom in Apple? I don't know. I don't know. I don't think so. If the market's going to go lower and tap fresh lows, Apple, down 34%. I mean, that's a pretty big correction. It's still trading relatively high for price to earnings. And this is part of the reason like Buffett was out of it, on top of probably wanting to be out of a lot of stocks. So anyway, Mag 7s have, some room, like lots of chop here on Amazon. Look at this thing, like getting beat up like crazy to 165, ripped all the way up to 185. It's very, very volatile. It has a really strong level here on the 150 handle. This is where I put in a ratio spread. I bought some puts to protect the positions that I'm in. I still have some shares of Amazon, and that cover is out to August for a 225 strike. So if Amazon recovers, I've got about 20 grand worth of profit that I'm looking to get called away. Otherwise, I'm just going to roll this down, roll this down, roll this down, and keep lowering my cost basis, try not to get it called away. But Amazon is still one of my favorite kind of long-term stocks. Broadcom, I'm staying out of this one for now. Google isn't awful. I don't know if the 150 bottom is the low, but I don't think I have much on Google right now. I think I got a lot of the trades closed out. Let me double check though. Google, I have some shares, got some ratio spreads. Yeah, I got to get these labeled in. So I just sold some puts. I did some ratio spreads on Google. Let me get these updated. So Google here, January, this is a ratio spread. And the 50 put, that is, I think that was just a long-term hedge. So let me put in, that only cost me 14 cents. I'm just going to put a hedge here. There. So I have a naked put that's showing small profit right now. Ratio spread is slightly negative. Ratio spread here, slightly negative. I need to see if Google can stay above 150 by May. They have earnings next week. I'm hoping there's some resiliency and a little bullish seasonality. Ratio spread here all the way down to 100. This one's up 30%, but I want to be 70, 80, 90% profit on that. And then a hedge, if the stock dumps, then it's far enough out of the money and far enough out in time that I can probably turn a 14-cent debit into maybe a few $100 of profit. So, all right, that's Google. That's just Mag 7 talk. Meta. I think Meta still has room to fall. I kind of hope that it does because I'd like to scoop up Meta at 2 spots right here. Previous resistance becoming support. I think that's a good opportunity to consider getting long Meta. Percentage-wise, that would be around a 40% correction, 48% correction. I mean, don't forget that Meta was down 76% during 2022. I do think technically this is a great spot. I think Meta has shown its colors as a true profit machine. I know there's some potential worry that Meta could be hurt by China quite a bit. If we resolve that, then I think Meta looks a little bit better. It's getting close to what I would consider, relatively like safe play. Let me see if Meta, this is going to be maybe expensive, but let me take a look at a calendar spread, or not a calendar spread, a diagonal spread. If I went out to, let's go December of 2026 or even January 2027, if I bought a deep in the money call, yeah, I mean, that's going to be a 20 grand trade. Like there's no freaking way I'm going to take that trade. If I were to buy, that's expensive. So $400, I would say, okay, if I owned the asset at $400, and I think we can go back to all-time highs, 740. See what this looks like. Yeah, I don't love it. That's an option trade where I'm risking 13,000. I'm buying a call as opposed to just like, well, hell, if I want to own the shares, I might just do a ratio spread. So could I do a ratio spread? Maybe out to January. Do I want to own the shares at 3 something? Maybe. I don't know. I think that's a little pricey for me to be like, yeah, let's do a ratio spread. Let's do a 1-1-1. I'll probably hold off. Do you trade currencies based solely on technicals with dollar cost averaging technical trades? What else do you do? Yes, technical. And yes, I build positions at levels that I'm confident in, support resistance levels, and mostly position trading. Yes, I don't do a lot of scalping in Forex. I was a day trader when I started trading for currencies in 2007. I traded 1-minute charts for like 2 years. It was fine, but it's not my style. It's way too stressful. The guy I was trading with at the time that introduced me was he was a fund manager and trading anywhere between 30, 40, 50 lots a day. I was trading half to one standard lot a day. I still didn't like the emotional swings of like winning $200 or winning $500 or losing $200 to $500 a day on a tiny little $2,500 account. So I started going big picture. I started looking at more currencies. I started to expand my horizons. I started to really think about the position trading, and it just helped me stay very present, stick to the investment style strategy, which is like I don't mind building small positions and holding if it takes, 3 months, 6 months, 12 months, but I can still make 30, 40% a year. I'm going to do it, and it was a lot less stressful than trying to day trade. So anyway, but to answer your question, yeah, I mean, when you say solely on technicals and dollar, I mean, what else would you base your trading on? A guess? I mean, of course I'm going to base it on technicals. Mostly technicals. Fundamentals, fundamentals. Here are my thoughts. Forex is, I would say, 95% technical and 5% fundamental. Okay, and they're both important because the biggest and most irrational moves are technical plus fundamental. What I mean by that is the dollar. The dollar index this year has been a technical setup from the tops we saw to a fundamentally driven move that has made it way more volatile and way more extreme. The dollar index is down 9% for the year. That's the worst start since 1995. The Japanese yen in 2022, the Japanese yen in 2012, the pounds in 2016. All those setups were technically seen. Like you can see a top forming, a bottom forming, you can see the runs, but when they get ridiculous and big and they stretch for hundreds of pips or thousands of pips with no pullbacks, that is the fundamental fuel that is driving the technical move. So if you're a pure Forex trader, it's mostly technical. And the news happens to typically fall in line with the markets. What you see on a chart is probably what the news is going to align with. Where it gets nasty is if you're trying to pick tops and bottoms. Okay. Phantom, it was a tiny $200, it was a $2,500 account when I first started trading Forex in 2007. So it was a tiny account. $2,500, turned it into 10, struggled at 10, went to 7, went to 8, went to 9, went to 10, went to 11. Felt like I was going to be confident enough to generate some income, so I put in another 10. I was at a 20K account, lightning in a bottle. 20K turned into 150K over a year and a half. From that point forward, my stock portfolio was doing well. Forex wise, I had a nice little nest egg to work with. I had some more leverage. Now I was playing the big picture. Now I was trying to preserve capital. I didn't want to lose that money. So it's like, how can I leverage and work with a 6-figure account to generate, maybe 10, 15, 20 grand a year? And I've been fortunate to do more than that, do better than that, but I've had mostly about a 20% annualized return without taking on a ton of risk. So yeah, $2,500. Would you consider doing ratio spread on Google? I already did that. I already did it. It was a 105 by 100 ratio spread to December. So, all right, back to this question from Quang. I am a technical trader that tries to stay in the same awareness of a fundamental move. So the tricky part is if you're trying to be a technical trader and you're overbought or oversold and you're trying to call the top or bottom, very difficult if the move is fundamentally driven. That's when you could be busted up by a flash crash. You want to wait for that confirmation to see the top and bottom turning. But for the most part, this is why I prefer and stick to currencies that are mostly technical. Aussie CAD is very technical. New Zealand CAD is very technical. Aussie New Zealand is very technical. Swiss pairs are mostly technical. But the last couple of years, they've been absolute garbage because they're just like, hey, the Swiss is strong, gold's up. And I've been in a 2-year drawdown. I've had of 6 currency pairs I'm trading in Swiss pairs. I've had one of them pay me. It was like, I don't know, dollar Swiss paid me, I think, like 15,000 pips worth of built up positions. So it paid very well. But it was not fun to sit in that trade for almost 2 years. And now I'm back into it again. And I'm just kind of waiting to see, like, okay, where do I scale back in? How do I play this? Is the dollar going to get worse before it gets better? So I'm kind of back in the same situation again. Right? Fanta says that fundamentals are what drive technicals. No, I think it's the. I mean, look, man, this is the. There's a. Let me find the joke. Something to the effect of you got a technical analyst and a fundamental analyst sitting at dinner having food, right? They're having dinner together, and one of them bumps the knife off the table and it starts falling, and it hits the fundamental analyst in the foot, and the knife stabs him in the foot, and he tells the technical analyst, "Hey, why didn't you stop it? Why didn't you do anything?" He's like, "Well, I don't catch a falling knife." says the technical analyst. And he's like, why didn't you move your foot? To the fundamental analyst, he says, I didn't think it'd fall that far. So either way, it's like, you're not right, you're not wrong. You got to have both of them. Ultimately, they're both the same trader. Like, you can't have one without the other. So I don't believe that if all here's why I disagree with just, fundamentals drive. If all you did was watch every news report and trade the news, you'd never get it right. You'd never get it right because the news is priced in way ahead of time, or the news is lagging, and all of a sudden it's like, oh, this is why the market's moving and doing this. The news is just built in as like the excuse of why the markets are moving. It's a why. It's an attachment. It's a reason. It's a rationalization. But look at the charts, and that's usually where you get most of your clues. In my opinion, the charts give you the clues, and the fundamentals kind of fill in the blanks. That's what I think. So that's at least been my strategy and style, because I think I've made a lot better trades being technical and ignoring the news. So trade the charts, let the news fill in the blanks. You'll probably make a lot better trades, right? Because also you have a plan of where to get in, where to get out. You got a plan on risk reward. And if you ignore the news, you don't second guess it. You just take the trade and it becomes a black and white, I win or I lose, and that is it. So that's technical if you ask me. Fundamental is you're getting caught up in the minutia and the granular details of why something is happening, and you're trying to potentially rationalize something that is irrational. So anyway, do I post all the final videos? Yeah, the final hour videos are on my YouTube channel. Every one of them. So go to youtube.com/Chris Pulver. You can go into the live sessions, and these are all live right now. And yesterday's final hour, and before that, and before that, and before that. So yeah, they're all posted. Thanks to YouTube, easy archive. Creeping up on 900 videos on the YouTube channel. Cool. All right. I should quote that. I'll watch it and see what I said. I do have some quotes, though. I'll share some of my favorite quotes. These came up in a lot of private sessions and workshops that I've done. See it, protect it, collect it. Okay. Trade to be profitable, not perfect. What else? I think that might be it. Oh yeah, trade, confirmation, not anticipation. I mean, just over the years, like, these are kind of my gems that I've had and come up with over the time working with traders and just being in the markets for all these years. It's like, it's true. I've had lessons where it's like, there's so many times where I'd love to guess where that bottom is, or love to guess where that top is. And sometimes I guess, and sometimes I'm right, and sometimes I guess, and sometimes I'm way wrong. And man, I've come back after those, like, agonizing, oh my God, I've been in this drawdown for a month because I thought the top was in, or I thought the bottom was in. So I just said, look, it's better for me to trade confirmation, where I've got the top is in and the bottom is in. The price is actually giving me what I want to see with all sorts of confirmation, and then I can trade that. Yes, I'm going to miss the exact bottom. I'm going to miss the exact top, but it feels a lot better than watching the market go further and further and further against you, way further than you thought it would go, because that's not trading. So trade confirmation and sacrifice a little bit of the perfection of the tops and bottoms, but not anticipate, like trade anticipate, or I'm sorry, if you trade anticipation, you get yourself in a lot of trouble, because you don't know how much higher the market's going to go. You don't know how much lower the market's going to go. Obviously, in stocks, market goes to zero. That's as bad as it gets. In currencies, I thought there were 30-year all-time highs and lows that we could trade with. That also isn't true, because the Japanese yen broke highs and broke lows, and the Swiss broke highs and broke lows, and we've had flash crashes and all sorts of nasty stuff happening. So markets do what they want, right? And we're talking about gold going to all-time highs. Where's the top? I don't know. I guess there was a top yesterday, but is it the top? Probably not. Stock market, is there a top? No. Nobody knows. So this is probably one of my favorite ones, is trade to be profitable, not perfect. I know that my style of trading, it suits me. The way that I trade, I think I've got a big variety of strategies. I trade all sorts of different ways. I trade all sorts of asset classes. I don't really care how I get the job done. I just care that I can make money. I want to make money with the least amount of risk, because I want to survive. I want to stay in this market, be in this market until I'm done, until I die. So to do that, I'm a risk manager that is trying to use what is good opportunities that I see on the charts in my options chain, whatever I'm trading asset wise, to find really good opportunities and mathematical opportunities and probabilistic opportunities. That's how I make money. So it's not perfect, right? And the sooner I embrace like taking losses gracefully, the sooner I embrace, define risk and not being like all in on a trade and not trying to, the better off you are. It's okay to take a loss, right? It is not okay if you let losses get bigger and bigger and bigger and bigger to the point where now you let them get so large that you're tying up all your capital trying to fight a bad trade. And I've seen traders do it. I've done it. I mean, some of my worst drawdowns in my currency experience was holding a drawdown of like 20%. Like just using a simple example, like, okay, $100,000 account, I'm spending 20 grand of a drawdown fighting through a trade that I really never wanted to be in the first place because I called the top too early or the bottom too early. And now I regret it. But I'm not closing it. I'm like, I'm not going to take a loss. I'll work through the trade. And it takes me months of stress and annoyance and waiting for better signs and waiting for better technicals. And then I'm getting out with a very tiny profit or a very small break even. It's like that pain and drawdown is not worth it. So defined risk is better. Profitable is better. Not perfect. Nobody's going to be perfect. If they tell you they're perfect, they're full of shit. They're one loss away from being a terrible trader. And I've been there. Like I've been that close. Like Brexit 2016, it wasn't summer. It wasn't the Scottish referendum. It wasn't Brexit 2016 in the summertime. It was October 2016 when the flash crash happened, and I was over leveraged in the pound Aussie, and we had 1,000 pip flash crash move that cost me about 30 grand instantly. I ended up letting the price, go back a little bit. I closed out for about a $15,000 loss, and then I built through the next 3 months to get back those wins and close out for. It took me 4 months to build the trades back, but I was back on top again. But I felt like it was the responsible thing to do to take the losses and trade with a clear conscience in a clear chart, as opposed to sit and hold and hope that everything's going to go my way. That's not a strategy. And everybody, you all know that. This is all common sense stuff. You know that hoping and crossing your fingers and putting it all on the line, that's not a strategy. So, I've never had a crazy YOLO trade. It's like, yeah, I made some money during GameStop. Cool. I made money last year on a runner with Palantir. Cool. But it doesn't define my whole career. And maybe that's the difference. Maybe the legendary status of a Stanley Druckenmiller or a Warren Buffett or a Jim Simons or a Bill Ackman, like those guys made hundreds and hundreds of percents on one bet, and it's awesome and it's heroic and it's legendary. But I also think, like, what if that trade didn't work? I mean, I watched Bill Ackman trade Netflix without having any puts and protection, and he lost like $5 or $10 billion on a trade. He could have just put in a put. He could have bought a put to protect his entire portfolio, and he didn't. So anyway, all right. OT says I was actually interested in the Telegram group. I know I posted the Telegram group. I posted that earlier. So I've got the Discord. I posted Telegram. All right. Thanks, Jason. You don't consider interest rate differentials in Forex? Of course I do. That's why I'm long against the Swiss. I'm enjoying some swap. I've been paid over the last couple years. I've been paid around, let me find out here. Around $37,000 in the last 2 years of holding swap on Swiss. Okay. I'm still upside down in drawdowns, but I've pulled in $37,000 in positive swap. So it's better than paying it every day. And and sooner or later it's going to be less attractive. I mean, if interest rates start to go down and central banks start to cut, okay. I mean, I don't think we're going back to negative interest rates anytime soon. But if I can manage a 2 to 3% swap on some of these pairs, like, I'll get it, and I'm hoping that the technicals will respond to what I'm seeing on the Swiss charts. And all in all, it's like, okay, positive swap plus the technical profits, and it's a win-win. And then I'll see what's next. So, all right. What else? Remember having a losing streak? I was down to 15% in a week. Why don't you just wait until it goes back and say, ugh, Adrian, you gotta ask your girlfriend if she knows what martingale is. Again, it ends badly. And honestly, like, so what'd you do? Did you take a loss? Did you end up taking a loss? And here's the lesson, right? if you traded too big and that drawdown was too large, the flip side of that story is you can lower your trade size, you can lower the risk, and that 15% the next time it happens could be half, right? I mean, the difference between a 7% drawdown and a 15% drawdown is a big difference. Psychologically, huge difference, you know? But I think it just depends on the market. I mean, I'm trying to think, like, if I was short Palantir in 2024, if I was short Palantir 2024, I'm an idiot, number one. But I would not want to be sitting and fighting and hoping. It's like, point is, I mean, I don't know. I mean, it just depends on the asset. I think in currencies, you have a little bit more luxury of holding and kind of digging your heels in and saying, okay, I'm going to fight this one. But do not do that on the Japanese yen. And I'm telling you from past experiences, I have seen traders blow up fortunes by being wrong in the Japanese yen. I've seen people make a lot of money in the yen when they're right, but I've seen the dollar cost averages and the people that aren't going in the same direction of the trend and not trading what they see. The Japanese yen is a ruthless currency pair. If you are not trading what you see, if you're not trading the obvious trend, then you're probably fighting something that's going to go thousands and thousands of pips against you, and that will blow you up. I know a trader that was trading millions of dollars on the pound yen during 2008 and blew up an entire account for several $1 million, and it happened in 3 to 6 months. So yeah, I mean it can sting if you're. So Adrian, to your point, like you took the loss, and let me ask you, were you able to trade to get it back? Hopefully, yes. So taking a 50% haircut is a lesson that you'll never forget. It'll make you change your strategy a little bit. It'll make you modify and refine, and hopefully you come back as a better trader. But that is a survival game, right? Like you survive that 15% because it could have gotten worse. 15 can become 20, becomes 25, becomes 30. Now it's worse. Taking the loss, thinking clearly, looking at the charts again, focusing on another asset, whatever. You can trade what you see. You can trade, something else. But I just, when I've had close calls in my career, it's crazy to think like one more push in the wrong direction could hurt me even worse. Managing a 20% drawdown, they getting pushed again for another flash crash could hurt all the worse. So I try to avoid that by trading smaller. If I'm going to stay in something, I'm trying to trade pretty small and make the risk really, really conservative. Okay. What are your most crucial tips for determining trend and basis or trend and bias? I mean patterns, honestly. I've got a whole course. Let me see if I can find it here. Actually, it's in my Discord. I'll bring my Discord channel here. So Discord, patterns are probably my favorite things in the markets. There is I think it's legacy education here, education legacy course. So this survival trader, this is a video series that's like 10 hours long. This is some of my best pattern, symmetry, big picture, technical analysis, like all that is here. So, head and shoulders, crown patterns, cup and handles, double tops, double bottoms, rising, falling wedges, flag patterns, routed tops, routed bottoms, you name it. Like all of my favorite patterns that I've traded successfully over the years are all there. The breadcrumbs are always in the charts to me. I mean, so that's why I'm saying like, Aussie Swiss I've talked about this all week. Look, I know that I'm dollar cost averaging Aussie Swiss. Here is my break even. I'm not that far away from making money on Aussie Swiss, right? These trades are still pending. And what I'm looking for is, look, I know that if I'm right in this position, this is sitting at a historical low. The Aussie Swiss, even through a literal flash crash in 2020 and this literal flash crash in 2024, is now trading below that. So if there is a balance between buyers and sellers, I would like to think that after 30 plus years of this pair, it doesn't really want to go too much lower, right? Too much lower. So what I'm looking at is what's going to emerge. Well, hopefully, if we do put in a bottom, that this works its way back up to find resistance, works its way back down to find a retracement level, and then works its way back up to find a follow through. So if that's a 3-wave move, there's 1, 2, 3. If we have a 4, 5, that's a great spot for profit if I'm going to hold the trade that long. But even if this is a movement here, pull back, movement here to symmetry, get the heck out of that trade for profit. Okay. And also, because I've been in this market for a long time, I've also seen that this might be another push lower, and then the market comes up and forms the bottom, right? And then this level and this level become a larger pattern, and we have a left structure, center structure. That becomes a three-wave move. But all in all, it just ends up forming a big pattern low that I can trade. Okay, most patterns are woozy wazy. Never heard that phrase in the technical market, but they're not, because they are self-fulfilling. What patterns do now, because look, retail traders are smarter, they have more resources, they have software and AI crap that calls out patterns now. And so what happens is liquidity is messy around the major turning points of these patterns. So here's an example. Okay, if I was going to talk about a head and shoulders pattern, let's talk a topping head and shoulders pattern, something like this. Okay, where are traders going to be potentially faked out in this market? Okay. If we're trading right here in real time, this is an area that traders would be anticipating a potential turn to go back down if this is going to be a right shoulder. Okay. So how does the market mess with their heads? Well, the market, if it does turn and become a right shoulder, well, that's great. If you get it right, that's great. But if you get it wrong, it's very possible the market goes back up here and tests this high, and that becomes the resistance level. And rather than going to a symmetry point for a head and shoulders, you should then trade it down to the low and take the profit there instead of taking the profit there. But if it's a double top pattern, it actually can go all the way to a second layer move. So these patterns evolve into, you think you see a pattern, but there could be 2 or 3 patterns it morphs into to still be a valid trade. If this is still resistance, it is still resistance. If this is still support, it's still support. If this is still a pattern, it's a pattern until it's invalidated. So the only way that head and shoulders pattern is invalidated is if price was going to go all the way back up here and take out the high. Then it's invalidated. But if that comes all the way back down to the lows, well, hell, it's a broadening pattern now. See what I'm saying? Like, these things can evolve. But if there are major, major technical reasons for this to be a top, I'm probably going to stick to my guns and try to trade it and take some stabs and take some nibbles, but not go all in. I just have to be patient, you know? And that's what's tricky, is because the markets will play a lot of games. The markets will play games at very obvious levels, and the markets on head and shoulders will play a lot of games here at the neckline. Why? Because this is where the market should be breaking out and going lower, but what happens instead is price will do something like this, and it gets very messy over here, and then it comes down to the neckline and it breaks and it fakes out and it gets messy over here, and then it ends up pushing lower. So at these really critical turning points, you see patterns that get really messy, and you think it's like, well, did I get it right? Am I wrong? Is this not a pattern anymore? It's just all sorts of market ways to confuse you. It does make trading challenging, right? But patterns can evolve. A major topping pattern is likely going to still stay a valid major topping pattern, but it could also become a double top. It could also be divergent up here and go back down and be a broadening pattern. It could be all sorts of things. It's literally like every pattern might morph into 2 or 3 different things. And that's what sucks, because it's very challenging to accept that, hey, if I put a stop loss here, you might get stopped out, but you could still be right on the overall trade, which is why I like to trade small, because if I'm wrong, I'll give it some wiggle room. I'll give it some wiggle room. I'll give it a couple of days. I'll give it a couple of weeks, and there you go. Watford says confirmation over anticipation. Exactly. So it doesn't have to be pick the perfect top or bottom. But I mean, look, if you have a pattern like this, and you can trade what you think is going to be a turning point, look at a daily chart. And let's say this is the daily pattern. We'll zoom in on a 1-hour chart and make sure that the 1-hour chart is confirming a sell zone. If the 1 hour confirms a sell zone, trade that sell zone, stop loss above where it needs to be. And then if you're right, it goes down to the daily neckline. And if you want to take some profit there, you can. If it wants to go lower and it pulls back, then just stay with it. You know the measurement, but you're going to have to go after, bigger time frame to line up with a smaller time frame. Do I look at specific candles? Not really. I mean, a candle pattern emerges here and there, yes. A mini price pattern inside of a price pattern emerges. So example be like this. I mean, if we had a head and shoulders, I'm just using simple examples here, obviously. But if we had a little pattern here, yeah, that's a topping pattern, and you can trade that pattern into the larger pattern, right? Or if this was a head and shoulders that came up and it formed some type of like rising wedge, and then it breaks the wedge there, it's like, yeah, then it traded back down to the neckline. So a pattern within a pattern works a lot. Whether to take the next market structure level, support supply and demand, or to hold through it. I mean, this is really a question of how how much conviction you have for your trade. Because if you are trading this pattern, you know, this is what I go through in this course. Like this entire course here, I talk about where things are at, what measurements they are, how to stay in these positions, how to add to your winning trades, how to build positions up to a profit that is. The nice thing is the reason I can make some good returns in patterns like this is because if I'm right on a pattern, okay, let's say I anticipate and I get a trade running and I stack up orders down here. Well, if this turns, I can take, one trade that's going to be a test and then add maybe two or three more trades that are proven right. And all of a sudden I have what, maybe was going to cost me, let's say $100 in risk. And if I add to my trade, this might offer me $300 of profit. Well, I've made more on this trade than I would if I just kept the initial trade in, right? And the flip side of that is if I get the pattern wrong and I trade here for trade one, and then it goes against me and I trade here for trade two, well, I can stomach a small drawdown. Maybe I'm down, let's say combination like $200 here to $300 here. But if I'm right and this thing comes all the way back down to this neckline, I can stack up some sell stop orders and turn what is a $200 to $300 drawdown into maybe $1,000 worth of profit. Well, that's still a reward to risk that's way bigger. Sorry, I've got something burning my eye. So that's just why I trade small. I give the market time to breathe, the market time to move and work, and then I give myself time to also confirm, patterns and price action. That makes sense? All right. My eyes are killing me. So yeah, I mean the next level, it's like supply and demand, sure. Support resistance, sure. I mean it all kind of, you can call it whatever you want. You can call things now like market manipulation and blocker blahs and sell blocks and who the hell cares? Liquidity channel. It's all the same stuff. Structure in the market, support resistance, supply and demand. They've been called that for decades. Call it whatever you want. Point is, if you can read a chart, you can see things happening, you can respect highs and lows, draw your trend lines. Price behaves, and when it's open space is a great time to be trading. Indecision, if you like to trade the indecision, great. Just don't ignore the bigger picture, because eventually when indecision becomes a big breakout pattern, it's going to move and it's not going to behave the same way. So that's where you go from range trading and all of a sudden breakouts and trends that last for months. Okay. All right. So whatever you want, there's all sorts of ways to do it, everybody. At the end of the day, the most important thing truly is risk management. Risk management will survive the markets. There will be countless opportunities to be profitable. I can say that as somebody that's been in the market since the year 2000. There are so many things that I've traded through, and not even knowing, but just so many things I've traded through that offered up profit potential, or things I didn't even see, trades that I missed. It doesn't matter. I mean, if you missed it, there's another one. It's going to set up somewhere. It's another asset, it's another currency, it's another whatever, and you can be a trader, you can be an investor, you can blend the two together, you can do both, you can do all sorts of things. But risk management is ultimately what keeps you in the game to be around for that next big opportunity. There will be a lot of them. There really will be. But I hate the stories of, traders blowing up their accounts because they were too risky and there's too much leverage and they just didn't manage risk. Right? All right. So I don't know. That was a fun session. Little flashback. So in my Discord channel, I mean, I've got links to all this stuff. So this is Survival Trader. In my education here, education updates, I think I put all this stuff in here. So all my services, trade alerts, services I run every single day, sessions, weeks. I mean, I've got day trading services, I've got swing trading services, weekly services, discretionary services, trade alerts. But, again, you know where to find me. I'm here on YouTube, in my Discord, in Telegram. Let's grind. Always a grind. Last question here. Do you take into consideration the percent of your trade? Like trade is 2% profit. Price action seems to be getting very confusing. We'll close and wait for more confirmation. Sure. I mean, honestly, I trade so small that most of the time my risk is under 1%. It doesn't even make me flinch until I see like a 2 to 3 to 5% drawdown. That's what gets my attention. And that's if I'm not using defined risk. When I'm option trading, I'm risking like fractions of 1%, fractions of 1%. I take thousands of trades. I win lose. But if you've got a trade running, like let's say that your risk was, and some traders are like very strict on like, okay, this is a 2% risk. Okay, well, if 2% risk is your firm risk, and you're not going to let it get worse than that. Then 2% risk, if you have the opportunity to go break even at 2% profit, well, now you can't risk anything on the trade. You're gonna break even. That's a win. Okay, but a 2% risk that only gets 2% profit, you have to at least win 50% of your trades to break even. So that's the trader that probably needs to make, 55, 60, 65, 70% win rate in order to feel like they're accomplishing some of their profit goals. You know, I don't, and this is something I've never really done in my career. I've never had a lot of trades where my asymmetry is just crazy, crazy high. What I tend to get for my reward to risk to be bigger is like I showed, I build small, and then my positions go to the profit levels and the symmetry patterns and all the projected levels that I have. And when it hits those targets, then I'm out with profit. And I typically build that position up to be a bigger win than what I was initially in with my risk or drawdown, right? When I trade options, I try to book a lot of trades that are asymmetry. I try to look at high reward to risk, but I also take a lot of backwards where it's like, look, this is a 95% profit. I'll make $100 if I'm right, and I'll risk $1,000 if I'm wrong. And if I take 1,000 of those trades, I have to have a high win rate, but I need 10 winners to make up for a loss, and I'll trade through it. And usually I can have a pretty good win rate over 100 or 1,000 trades. So if you're strict on the percentage, I look at it this: anytime you can protect for a surplus, that is a good thing. So if you're truly risking 2%, right, and you're up 2%, break even is fine. But if you get stopped out at break even, that's still risk that you never really accounted for. That's still risk that eventually puts you in the hole. So if you're going to take a 1-to-1, take your 1-to-1, But anytime you can get that 2% risk to pay you 2.5%, pay you 3%, pay you 3.5 to 4%, that's the profit that makes life a lot easier. So if you have that type of reward to risk that is paying you more than what you're initially risking, that is really, really helpful, because those are the type of trades where now you only have to win like 35% of your trades. If you find a good trade, look, I think a lot of traders out there with some basic chops and technical analysis can find direction probably, 50 to 75% of the time and get direction right. Better than a coin flip. A coin flip is garbage, right? But I can find direction probably 60, 70, 80% of the time. Feel pretty confident that I've got the right direction. Maybe not the perfect top or bottom, but direction. And I can craft my trades from that. So if you have a trade direction right, and you have the risk to reward that is paying you a surplus, those are good profits to protect, because that way you don't have to win all your trades. That way it's like, even if you win 50% of your trades, but every time you win, you're making, $150. Every time you lose, you're losing $100. Just simple example. It's like you're making more money. So it's a little bit easier to stay ahead and battle-proof or bulletproof your accounts. Make sense? All right. Okay, that was fun. Good questions. I appreciate the engagement. As always, hit the thumbs up button for me, please. Support the channel. It helps. Hopefully, we're climbing towards 10,000 subscribers this year, and off we go. Hopefully, it's organic. I don't want any bots. I get the same stupid question all the time. My comments like, "Hey, Chris, great video. I got this question. OKT, blah 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 wallet, blah blah blah." It's like I don't know how I get that crap in my channel. So just bots and spam and garbage. It's out there, but I appreciate the real comments. All real traders, and we'll come back and do it tomorrow. All right, thanks everybody. See you. Bye.